While most dividend ETFs are bleeding money in 2025, I found 4 ultra-high-yield funds that are not just surviving, they're actually making money, and one of them is paying nearly 6% while beating the market. Most investors are getting crushed chasing dividend yields this year, but these 4 funds have cracked the code. They're delivering real returns while most high-yield ETFs are falling into dividend traps. By the end of this video, you'll know exactly which funds are worth your money and which investment strategy matches your goals. Let's dive into the only 4 high-yield ETFs that are actually winning in 2025. Here's what nobody tells you about high-yield ETFs. Most of these funds are designed to chase yield over quality, and that's exactly why they're failing in 2025. They fall into what we call dividend traps, companies with unsustainable payouts that look attractive on paper but are destined to cut their dividends. When a company offers an 8%, 9%, or 10% dividend yield, there's usually a reason the market is pricing it that low. Either the business is struggling, the payout ratio is unsustainable, or investors expect a dividend cut. This year has been brutal for yield chasers because rising interest rates and economic uncertainty have exposed these weak companies. But here's the thing, smart money knows there's a better way. Instead of chasing the highest yields, sophisticated investors focus on sustainable dividend strategies that balance income with quality. Now, let me tell you exactly why I chose these 4 specific ETFs, and it's not what you might think. I didn't just pick the funds with the highest yields. In fact, I applied a strict filter that most YouTube channels ignore. I only selected ETFs that delivered positive returns in 2025, combined with strong 1-year and multi-year performance. That's a crucial difference. Many ultra-high-yield ETFs have negative returns or unstable payouts, but all 4 of these champions combine above-average yields with actual price appreciation and resilient performance. I spent weeks analyzing hundreds of dividend ETFs, and these are the only 4 that passed my rigorous selection criteria for 2025. ETF number 1. RDIV. Let me introduce you to the Invesco S&P Ultra Dividend Revenue ETF, ticker symbol RDIV. Here's the genius of RDIV. It doesn't just look at yield, it looks at the business behind the yield. This fund was launched by Invesco Capital Management back in September 2013, and it tracks the S&P 900 Dividend Revenue Weighted Index. But what makes this fund special is its sophisticated revenue weighting methodology that sets it apart from traditional market cap weighted funds. RDIV starts with the S&P 900 index and applies multiple smart screens to avoid dividend traps. First, it excludes the top 5% of securities by dividend yield, which means it's automatically avoiding the companies with suspiciously high yields that could be dividend traps. Second, it excludes the top 5% of securities within each sector by dividend payout ratio, which helps avoid companies with unsustainable dividends. Then it selects the top 60 securities by dividend yield and reweights them by company revenue with a maximum 5% weighting per company. This approach is brilliant because it favors companies with actual business success rather than just high yields, creating more sustainable income streams. But here's why RDIV made my list. It focuses on large-cap value stocks from the S&P 900, but uniquely weighs holdings by company revenue, not just yield or market cap. This helps avoid dividend traps and prioritizes businesses with real cash flow and operational strength, increasing the odds that high yields are sustainable over time. The fund offers a 4.16% trailing 12 months dividend yield with an annual payout of $1.99 per share. Now, that might seem modest compared to some high-yield funds, but here's why it's actually the sweet spot for sustainability. The expense ratio is 0.39%, and the fund manages $813 million in assets across 60 holdings. The top holdings tell the story of quality. U.S. Bancorp at 5.35%, Chevron Corp at 5.27%, Best Buy at 4.81%, Prudential Financial at 4.67%, and AT&T at 4.63%. These aren't speculative dividend plays. They're established companies with real revenue and proven dividend track records. The fund pays quarterly distributions, with the last distribution being 47.3 cents on June 23, 2025. Since 2013, this methodology has proven that sustainable beats spectacular. The fund has delivered a 16.42% annualized return over the past 5 years and a 2.89% return over the past year. In 2025's challenging environment, quality dividend strategies like RDIVs are being rewarded over pure yield plays, which is why RDIV is up 1.04% year-to-date while many high-yield funds are in the red. ETF number 2, SPYD. What if I told you that you could invest exactly like billion-dollar institutions for just 7 cents per $100 invested? That's the magic of the SPDR portfolio, S&P 500 high-dividend ETF, ticker SPYD. This fund is managed by State Street Global Advisors and launched on October 21, 2015. It tracks the S&P 500 high-dividend index using a straightforward, no-nonsense approach that has attracted nearly $7 billion in assets. SPYD's methodology is simple but effective, and here's exactly why it earned a spot on my list. It tracks only the S&P 500's 80 highest-yielding names, so you get established, blue-chip companies with proven track records. Its equal-weight approach avoids putting too much risk in any one company or sector, giving you stability and diversification, plus an extremely low expense ratio for better long-term compounding. The fund ranks all dividend-paying stocks in the S&P 500 by indicated yield, selects the top 80 companies by dividend yield, equal weights the portfolio so each holding represents about 1.25%, and rebalances twice annually to maintain equal weighting. This simplicity is actually a strength because it provides transparent, consistent exposure to the highest-yielding companies in America's most prestigious stock index. The fund currently yields 4.53% with an annual dividend payout of 1.84 per share. But here's the revolutionary part. The expense ratio is just 0.07%, making it among the cheapest dividend ETFs available. With $6.84 billion in assets under management and 80 holdings, you get institutional-scale liquidity at retail prices. Morningstar has awarded SPYD its highest gold rating, recognizing the fund's superior methodology and execution. The top equal-weighted holdings include Hasbro at 1.74%, Philip Morris International at 1.67%, Invesco Ltd. at 1.60%, AT&T at 1.59%, and Franklin Resources at 1.59%. The sector allocation tells you where income lives in the S&P 500. Real estate leads at 23.33%, followed by utilities at 18.24%, financial services at 15.31%, consumer defensive at 14.42%, and energy at 7.29%. SPYD has delivered strong performance with a 5.83% return over the past year and is up 2.80% year-to-date in 2025. The fund's last distribution was 50 cents on June 25, 2025, paid quarterly. With $7 billion in assets, you get institutional liquidity at retail prices, and the equal weighting methodology prevents overconcentration in any single company. This is what sophisticated, cost-conscious investors choose when they want S&P 500 dividend exposure without paying premium fees. ETF number 3, NUDV. Meet the fund that proves you don't have to choose between doing good and making money. The Nuveen ESG Dividend ETF, ticker NUDV, launched on September 27, 2021, with a mission to find high-dividend companies that also pass strict environmental, social, and governance standards. Managed by Nuveen Fund Advisors, which is part of TIAA, this fund tracks the MSCI Nuveen ESG USA High Dividend Yield Index. NUDV combines high-dividend investing with ESG screening in a sophisticated way, and here's why this strategy earned it a place in my final 4. In today's market, ESG screening doesn't just align with global values, it can help avoid companies at risk for scandals or unsustainable business models. ESG screening adds a layer of safety while still reaching above-average yields. The strategy starts with the MSCI USA Index and applies multiple filters. First, it screens for companies with higher dividend yields than the parent index. Then it applies ESG exclusions, eliminating companies involved in alcohol, weapons, nuclear power, gambling, and tobacco. It also excludes companies that exceed carbon emission thresholds. After these exclusions, it scores the remaining firms on ESG factors and selects the highest-scoring firms within each sector using multi-factor optimization weighting to maintain similarity to the parent index. The result is impressive, a 5.65% current dividend yield with an annual payout of $1.58 per share. That's higher than most traditional dividend funds, proving that ESG screening doesn't hurt yield potential. The expense ratio is a reasonable 0.26%, and the fund manages $31.34 million across 94 holdings. The fund pays quarterly distributions and has a beta of 0.95 versus the S&P 500, meaning it's slightly less volatile than the broader market. The top holdings showcase quality ESG-compliant companies. The Procter & Gamble Company at 3.04%, Bank of America Corporation at 2.69%, the Coca-Cola Company at 2.65%, International Business Machines at 2.46%, and Citigroup at 2.45%. These aren't just good companies. They're companies doing good while maintaining strong dividend policies. Here's what's remarkable about NUDV. It's the best performer among our 4 champions, up 2.54% year-to-date in 2025. The fund has delivered a 16.60% return over the past year and a 7.4% annualized return over 3 years. This performance proves that ESG isn't just trendy, it's profitable. Companies with good governance practices tend to have more sustainable business models and more reliable dividend payments. In 2025's market environment, this focus on quality and sustainability is being rewarded by investors who recognize that good corporate citizenship often correlates with good financial performance. ETF for 4. DIV now for the grand finale. The Global X Super Dividend US ETF, ticker DIV. While the other funds pay quarterly, DIV pays monthly, and it's been doing so reliably for 11 straight years since launching on June 8, 2011. Managed by Global X Management Company, this fund tracks the Super Dividend US Index and targets the 50 highest dividend-yielding equity securities in the United States. DIV's methodology is focused on maximum yield with some quality controls, and here's exactly why it secured the final spot in my selection. It gives monthly income from 50 of the highest dividend-paying U.S. stocks, adding a low beta volatility filter for a steadier ride. This combination targets regular high-yield income, not just occasional big payouts. The monthly payout appeals to people who want frequent, reliable cash flow, making it practical for retirees or income-focused investors. It screens the U.S. equity universe for the highest dividend yields, selects the top 50 securities by dividend yield, applies volatility screening to avoid the most speculative plays, seeks securities with lower beta relative to the S&P 500, and rebalances monthly to maintain its high-yield focus. This approach has resulted in the highest yield among our champions, a current dividend yield of 5.93% with an annual payout of $2.89 per share. The expense ratio is 0.45%. And the fund manages $1.2 billion across just 50 holdings. The concentrated approach means higher individual stock risk, but it also means more focused exposure to the highest yielding opportunities. The top holdings include Ardagh Metal Packaging at 3.24%, Global Ship Lease at 2.70%, Alexander's Inc. at 2.68%, Altria Group at 2.52%, and Philip Morris International at 2.37%. These aren't household names like those in SPYD, but they're companies that prioritize returning cash to shareholders. The sector allocation shows where the highest yields are found. Energy leads at 22.2%, followed by real estate at 18.6%, utilities at 16.6%, consumer staples at 10.8%, and materials at 8.8%. DIV has delivered an 8.26% return over the past year and a 10.01% annualized return over 5 years. In 2025, it's up 0.34% year-to-date, which might seem modest, but remember, this fund prioritizes income over capital appreciation. The real attraction of DIV is the monthly payment frequency. For retirees or income-focused investors, monthly payments can be a game-changer for cash flow planning. Instead of waiting 3 months between dividend payments, you get consistent monthly income. The fund has a beta of 0.71 versus the S&P 500, meaning it's less volatile than the broader market, with a standard deviation of 15.50%. With 11 years of monthly distributions, DIV has established the most reliable monthly income track record among high-yield ETFs. Let's break down how these 4 champions stack up across the key metrics that matter. Starting with performance rankings for 2025 year-to-date, NUDV at plus 2.54%, proving that ESG screening can actually enhance returns. RDIV follows at plus 1.04%, showing that quality-focused dividend selection pays off. SPYD comes in at plus 2.80%, delivering steady institutional quality returns. DIV brings up the rear at plus 0.34%, but remember, this fund prioritizes income over capital appreciation. For cost efficiency, SPYD is the clear winner with its ultra-low 0.07% expense ratio, making it among the cheapest dividend ETFs available. NUDV follows with a reasonable 0.26% expense ratio, which is fair for the ESG screening process. RDIV charges 0.39%, which is justified by its sophisticated revenue weighting methodology. DIV has the highest cost at 0.45%, but that includes monthly distribution processing and higher touch management. When it comes to dividend yields, the rankings show the trade-offs involved. DIV leads with the highest yield at 5.93%, followed by NUDV at 5.65%, which proves ESG doesn't hurt yield potential. SPYD provides 4.53% from S&P 500 quality companies, while RDIV offers 4.16% with its focus on sustainable dividends. For scale and liquidity, SPYD dominates with $6.96 billion in assets providing institutional scale liquidity. DIV follows with $1.2 billion offering adequate liquidity for most investors. RDIV manages $813 million, which provides good size and stability. NUDV, being the newest fund, has $31.34 million, which could create liquidity concerns for larger investors, but is adequate for most retail investors. Choosing the right ETF depends on your specific investment goals and priorities. For conservative income investors who want institutional quality at rock-bottom costs, SPYD offers the best combination of low fees, large scale, and S&P 500 quality. The 4.53% yield from America's blue-chip companies, combined with the 0.07% expense ratio and $7 billion in assets, makes this the most conservative choice. For ESG-conscious investors who don't want to sacrifice returns for values, NUDV provides the best recent performance despite its smaller size. The 5.65% yield from ESG-compliant companies, combined with the best 2025 performance at plus 2.54%, proves that sustainable investing can be profitable investing. For sophisticated dividend hunters who want to avoid dividend traps, RDIV appeals to investors seeking the most thoughtful dividend selection methodology. The revenue weighting approach and systematic exclusion of dividend traps, combined with an 11-year track record since 2013, makes this the choice for investors who understand that yield quality matters more than yield quantity. For monthly income seekers who prioritize cash flow consistency, DIV serves investors who need regular monthly payments. The highest yield at 5.93%, combined with 11 years of reliable monthly distributions and lower volatility, makes this ideal for retirees or anyone needing predictable monthly income. Each of these funds represents a different philosophy about high-yield investing, and the best choice depends on whether you prioritize cost efficiency, ESG compliance, dividend quality, or payment frequency. These 4 ETFs are winning in 2025 because they've each found ways to deliver quality over pure yield, which is exactly what the current market environment rewards. But let me tell you why this matters specifically in 2025's market environment. High inflation and uncertain interest rates make strong cash-flowing companies and reliable dividend income much more valuable. These funds focus on companies with the proven ability to keep paying, even when the economy gets choppy. With lower yields on bonds and savings accounts, investors are turning to high-quality dividend stocks and funds. These ETFs provide a balanced blend of quality, yield, and risk protection. What's really compelling is that many analysts now emphasize quality screens and diversified methodologies as essential for income investors rather than just chasing yield. This is reflected in strategies like RDIV's revenue screens, NUDV's ESG overlay, and SPYD's S&P 500 base, all praised by ETF researchers and financial experts. Each of these funds uses sustainability and risk controls that set them apart. Yield sustainability through revenue screens, ESG screens, equal weighting, or volatility filtering to help ensure that the income is sustainable, not simply a result of falling stock prices. You aren't loading up on just REITs or energy stocks either. Each ETF spreads risk. RDIV and NUDV diversify across multiple sectors. SPYD's equal weighting avoids overconcentration. And even DIV, while favoring income sectors, spreads bets beyond a single industry. This reduces the risk of an income shortfall if one sector tanks. However, all dividend investing carries risks that investors need to understand. These funds are sensitive to interest rate changes, with rising rates typically hurting dividend stock prices. They also have sector concentration risks, particularly in real estate investment trusts and utilities. Economic sensitivity varies by fund, with some holdings more vulnerable to recession than others, and liquidity considerations matter, especially for newer or smaller funds like NUDV. The key to success in 2025's dividend investing environment is understanding that sustainable yields built on strong business fundamentals will outperform unsustainable yields from struggling companies. These 4 ETFs have each developed methodologies that prioritize sustainability over speculation, which is why they're delivering positive returns while many high-yield funds are struggling. I picked these ETFs because each one blends high sustainable income with smart risk management. They feature robust systematic selection processes, actual positive returns alongside big yields, diversification and protections against common dividend ETF dangers like dividend traps or sector blowups, and a strong fit for 2025's economy, offering practical, steady income when you need it most. What I want you to understand is that the best high-yield ETF isn't always the one with the very biggest dividend number, but the one that delivers quality income, resilience, and smart risk controls for the long term. These 4 ETFs represent different approaches to high-yield investing, each with their own strengths and appropriate use cases. RDIV for dividend quality, SPYD for cost efficiency, NUDV for ESG compliance, and DIV for monthly income. Remember, past performance doesn't guarantee future results, and all investments carry risk. Always do your own research and consider your risk tolerance, investment timeline, and financial goals before making any investment decisions. Which of these 4 would fit your portfolio? Drop a comment below with your choice and tell me why it matches your investment strategy. And if you found value in this deep dive analysis of the only high-yield ETFs actually making money in 2025, smash that like button and subscribe for more investment insights that can help you make smarter financial decisions. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.